Let's talk about one of the most common conversations I hear between buyers. How much house can I really afford? Now, this is one of those questions that seems simple at first. You think, okay, I'll just see what I'm pre-approved for and that's my budget, right? Well, not exactly. If you only look at what the bank says, you might stretch yourself too far. You could end up in a beautiful home but feel stressed every single month because all your money is tied up in that payment. And trust me, that's not the way you want to live. So in today's video, I'm going to walk you through this step by step. We'll talk about the rules lenders use, the hidden costs that can surprise you, and then we'll go over how to figure out a realistic comfort zone for yourself, not just what the bank says you can handle. And here's the good news. Once you understand this, the whole home buying process feels a lot less intimidating. You'll know your numbers, you'll have set your own limits, and you'll feel confident moving forward. Hi, my name is Charles Fratantoni, and I've been a realtor here in the Valley for 15 years. I've helped clients buy and sell homes in just about every corner of the Valley. If this is your first time on the channel and you want to learn everything about living in the Phoenix, Scottsdale, and surrounding suburbs, then smash that subscribe button below so you can be the first to get detailed info on our current market. The 28-36 rule. So let's start with the basics. Most lenders use what's called the 28-36 rule. Here's how it works. They want your total housing payment, that means principal, interest, taxes and insurance, and any HOA dues, to stay under about 28% of your gross monthly income, meaning what you make before taxes are taken out. Then, when you add in all of your debt together, they don't want that number to go over 36% of your gross income. So that includes your housing, plus car payments, student loans, credit cards, anything else you're obligated to pay monthly. Here's a quick example. Let's say you make $6,000 a month before taxes. 28% of that is about $1,680. That's the number most lenders would aim for on your mortgage payment. And then if you had, let's say, a car loan and a little bit of a student debt, they'd want a combined total of all those payments to stay under $2,160. This gives lenders some assurance that you're not stretching too thin and that you can realistically make your payments. Now that's what the bank says, but here's the important part. Just because the bank says you can afford that amount doesn't mean it's the right number for you. The bank is looking at your financials. They don't know your lifestyle. They don't know if you love traveling, if you're saving up for your kids' college, or if you're planning to start a business next year. They don't know if you're the type of person who feels safe with a cushion of savings every month, or if you're just comfortable cutting it close. So when you get that pre-approval letter, don't treat it like it's the exact number you need to spend. Think of it more as a ceiling. It's the maximum. You get to decide what actually feels comfortable under that ceiling. Now, in my opinion, it's a good idea to speak to more than one lender to get the best rate and terms. Banks are just like any other business, and while it feels like working with a bank is kind of a DMV experience, the lines, paperwork, rules that apply to everyone, that's not really the truth. Some banks are very conservative and have a higher and harder standard to meet. Others are a little more open in their approval criteria. And while you are dealing with an institution, the truth is that you will always end up dealing with a person. A human being will be handling your file and making decisions and reviewing your financial situation. Some of them are organized and diligent, others are less so. I've seen situations where a bank told a couple that they couldn't qualify and that with what they were saying, they would have a hard time qualifying anywhere, only to get approved on good terms with the next bank they went to. So getting two estimates will give you a good feel for your options. Now let's dig into something that surprises a lot of buyers. Mortgage payment is only part of the picture. There are other costs that come with buying and owning a home, and if you don't plan for them, they can throw your budget off balance. Let's talk through some of these. First, there's closing costs. These are the fees you pay when you finalize the purchase of your home. Things like lender fees, title fees, escrow, and prepaid taxes and insurance. Closing costs typically run between 2 and 5% of the purchase price. So on a $400,000 home, that could be anywhere from $8,000 to $20,000. Make sure your realtor has a good relationship with a couple of title companies so you get the best rate and service. A title company can make or break the closing experience. Next, property taxes and insurance. These can vary a lot depending on the neighborhood and the type of home. In some areas, they might only add a couple of $100s a month to your payment. In others, they could add $500 or more. Here are examples of 3 similar homes, all listed for sale for $580,000, but in 3 different Phoenix metro cities: Scottsdale, Phoenix, and Chandler. In Scottsdale, a $580,000 3-bed, 2-bath, 1,575 square foot home with an 8,400 square foot lot had a property tax bill of $1,443 for 2024. That works out to $125.25 per month. In Phoenix, a $580,000 4-bed, 2-bath, 1,766 square foot home with an 8,090 square foot lot has a property tax bill of $1,696 for 2024. This adds $141.33 to your payment per month. Now in Chandler, a $580,000 4-bed, 2-bath, 2,170 square foot home with a 7,722 square foot lot had a property tax bill of $2,394 for 2024. This added $199.50 to the payment each month. If you have a mortgage, you will need homeowners insurance. In fact, your lender will require it. How much will it cost? That depends on the value of your home. Not the sales price of your home, but it's based on the dwelling coverage amount of your home. And the dwelling coverage amount of your home is the amount the insurance company determines it will take to rebuild your home if it were destroyed. This means materials and labor based in today's construction market. It does not include the value of your land, location premium, or local demand. So the coverage amount is usually lower than your home's purchase price. Insurance companies use a cost estimator software that considers square footage, construction type, whether it's a wood frame home, a masonry home, stucco, etc., roof type and age, number of bathrooms and kitchens, and special features like fireplaces, vaulted ceilings, built-ins, etc. These tools estimate rebuild cost per square foot in your area, then you multiply by your home size. They calculate that today in the Phoenix metro area, rebuild costs generally run between $150 and $250 per square foot, depending on the finishes. So a 2,000 square foot home might need a $300,000 to $500,000 dwelling coverage. Luxury homes in Scottsdale or Paradise Valley can push it up above $300 per square foot, meaning coverage might be much higher than the purchase price of a standard home elsewhere. Homes in Phoenix might have fewer risk factors like flooding or wildfires compared to rural or forested areas like Flagstaff or Payson. Your credit score and claims history can dramatically increase your insurance cost. The average annual premium for the Phoenix metro area is $2,137 or $178 per month. Then there are HOA dues. If you're buying in a community with a homeowners association, there's often a monthly fee, of course. It can be $50 or it can be $300. And you need to know that upfront because it goes directly into your monthly cost calculations. Realtor.com data shows that the median HOA price for the Phoenix metro area is about $125 a month, but many of the older, well-established neighborhoods don't even have an HOA. And some of Scottsdale's more upscale neighborhoods can climb above $500 monthly. I toured a beautiful corner penthouse in Scottsdale's exclusive Optima building with HOA fees of $1,450 per month. Another expense people kind of overlook is utilities. Moving from a 1-bedroom apartment to a 2,500 square foot home, your electric bill, your water bill, and your gas bill, they are going to go up. And depending on how you live, things like heating and cooling can get expensive fast, especially in Arizona. How cool do you like to keep your home? Will you and your partner be out of the house at work most of the day, allowing you to turn down the thermostat? Or do you work from home or have a pet? The costs can vary wildly. Tammy and I set our AC at 75 during the day and 72 in the evening. But my Sicilian mom and dad are a totally different and extreme story. They keep their AC set at 80 degrees. And while 80 degrees feels wonderful when you're walking along the beach in Maui, it's not so comfortable at 3 p.m. in Scottsdale when it's 112 outside. And it doesn't seem to affect my parents. In fact, I don't think they break a sweat. In fact, my parents firmly believe that when a cold breeze, especially from an AC, hits you, you stand a very good chance of getting double pneumonia, which is what they call double pneumonia. On the other hand, their water bill is higher than mine because they have an extravagant garden, all the fruits and vegetables you can imagine. With what they save in the grocery store, they say it's a net savings. And finally, maintenance and repairs. As a homeowner, there's no landlord to call when something breaks. If the water heater dies, if the AC needs repair, if the roof starts leaking, it's on you. A good rule of thumb is to set aside about 1% of your home's value each year for maintenance. So if you buy a $400,000 home, plan for about $4,000 a year. Some years you won't spend that much, other years you'll be glad you had it. Lifestyle balance. This is where I really want you to pause and think, because you're buying a home isn't just about the numbers on a spreadsheet. It's about the life you want to live once you're in that home. Ask yourself simple questions. Do you want to be able to travel once a year? Do you like to go out and eat in restaurants on the weekends? Are you saving for retirement? Do you want to have money left over to furnish the home you just bought, or do you want to do upgrades over time? My mom and dad are an extreme example. I swear it feels like they can live on $200 a month. Apart from meat, they get a lot of their food from their garden, and what they have to buy at the store, they always seem to get for next to nothing because of a sale or a coupon. My parents can't work the TV remote, but my mom figured out how to go online on her phone and download grocery coupons. They have a flawless mental database of what is on sale and where, and have established great relationships with their grocers by bringing them my mom's famous fig cookies, and they get even better deals. I mean, who knows the name of the butcher at Safeway? I collect guitars, and Tammy and I love to travel. When we were younger and had 4 kids at home, we were happy to allocate more of our income to a larger house with a big pool for the kids. Now that the kids are up and on their own, we're happier with less house, but more travel. If buying at the top of your approval range takes away all these things, is it worth it? For some people, maybe. For others, not at all. Your home should support your lifestyle, not control it. And that's why the smartest buyers don't max out what the bank says. They buy a home that fits their budget comfortably while still allowing them to live the life they enjoy. So how do you actually figure out what's comfortable for you? Here's a simple process you can follow. Step 1, write down your income. Step 2, write down your debts. Step 3, use that 28-36 rule as a starting point to see what a lender might approve. Step 4, add in all of your lifestyle costs, groceries, gas, hobbies, travel, savings goals. Then step 5, decide what feels comfortable. If the number the bank gave you feels too high, listen to that. Pick a payment that lets you sleep at night and still enjoy your life. Remember, a pre-approval is not a command, it's a guideline. You have the final say. So how much house can you really afford? The answer isn't just about what the lender says, it's about what works for your lifestyle. The truth is, buying a home is one of the biggest financial decisions you'll ever make, and the last thing you want to do is feel trapped by your payment. So use the 28-36 rule as a guide. Add in the hidden costs, be honest with yourself and about your lifestyle, and then choose a number that feels right. If you're thinking about buying, reach out. I'd be happy to connect you with a great lender or two, walk through the numbers, and help you find a home that fits both your budget and your dreams. Thanks so much for watching. If you found this helpful, hit that like button, smash that subscribe button for more real estate tips, and drop a comment below. Tell me, what part of the home buying budget do you think surprises people the most? See you in the next video.